Hello guys, my name is Anish Lakapragada, and today I'm going to be talking about options. I haven't covered options in my videos on investing for kids by kids, so please check that out also. But I haven't really covered options, and I realized that this would be just a short video to get that out of the way if any of you guys had any questions or concerns. So hang in tight because this will go by pretty fast. Okay, so let's get right into it. So an option is the right to buy or sell something for a certain amount of time at a predetermined price. So I know this is a pretty chunky definition to kind of accept or understand. So let's just break it down. The right to buy or sell something for a certain amount of time. Now you may be thinking, what's the point of buying this fancy option contract to buy a share of Apple or a share of Facebook or Microsoft when I could just do that myself? There's no limit to when I can do that, right? Now here's the catch with options. You have the right to buy or sell something for a certain amount of time at a predetermined price. So if you didn't catch that, you have the right to buy or sell Apple as normal, but this time you get it at a predetermined price. That's the main difference between an option and the regular way of just buying or selling. In an option, you're buying it at a predetermined price before you even get the contract. Before you even buy or sell the contract, you know what that price is. So here, we're gonna head over to the all products section of the TD Ameritrade Thinkorswim trading browser. So we're in it right now. All the options can be found under all products. So let's go over here. Let's open up this option. So I'll go over expiration, strike, and calls and puts. But right now, just stay with me for as much as you can, okay? I promise I'll try to make all of this seem as clear as possible by the end of this video. So here, this option contract is telling me that if I buy this option contract, I can buy shares of Apple, a certain amount of shares, one share of Apple at $270. Its current price, let's notice this is 277.97. If I buy this contract, I can buy Apple. I have the right to buy or sell Apple or whatever, something, for a certain amount of time at a predetermined price. That predetermined price is also known as the strike or exercise price. So the strike price here is $270, which is below the current trading price. And for that certain amount of time, that's called the expiration. Sorry, that's called the expiration date. April 17, 2020 is the expiration date. This is what this option means. It's stating and it entails I have the right to buy Apple until April 17, 2020, and I have the right to buy Apple until April 17, 2020 at the strike price of $270. So any day until April 17, 2020, even on the day of, I'll go over if it's an American option or European option to clarify that. Even on the day of or any day, any time before that, I will be able to buy Apple at the strike price of $270. So yeah, right to buy or sell something, Apple, for a certain amount of time at a predetermined price. So expiration date, that's for how long you can exercise that contract. Strike price, what you pay. Now, in order to obtain that right to buy or sell something, I have to pay something known as a premium. In order to even use the contract, when I have to pay a premium, which is 24.55. That's non-negotiable, non-refundable. That's kind of the gist of it. Now, when I buy this contract, I have the right to buy or sell. That doesn't necessarily mean that I have to buy or sell. So I can buy this option and pay the 24.55 and then realize, okay, I just won't buy Apple because the time was really never there to logically buy it with the option I signed. So therefore, if I didn't exercise the contract, sometimes you may say that it's a waste of whatever the premium was in order to obtain that contract in the first place. So remember, premium is what you have to pay to obtain the whole contract. You don't pay $270. That's how much you're allowed to pay once you pay the premium to obtain the contract. Now, American versus European options is going by pretty fast. American options state that you have the right to trade an option until its expiration date and on the same day of that expiration date. So here, go back to the Thinkorswim browser. Here, I have the right, if this was an American option, I would have the right to buy Apple at $270 until April 17, 2020, and on the day of April 17, 2020. European options, they only operate on the expiration date. If I bought it and this was a European option, it would state I can only buy Apple at $270 on April 17, 2020. So yeah, keep that in mind. American means until the expiration date on the expiration date. European options only on the expiration date. Now, I said that an option is the right to buy or sell. So there are different types of options. The two main types are calls and puts. This option right here, which I've been using as an example for quite some time now, is a call. A call states that when you buy a call, you're saying that I have the right to buy Apple or Microsoft or Facebook or ExxonMobil or whatever share at that strike price. A put, on the other hand, let's see if this works. Yeah, a put says I have the right to sell Apple or whatever share at the strike price. Remember, you can sell a call and buy a put. In order to obtain the call, you have to obviously pay the premium. In order to obtain the put, same thing, you have to pay the premium. But do not think that because a call means that you have the right to buy, that you must have to only that you can only buy the call, and vice versa. Because a put means that you have the right to sell, you can only sell a put. Don't think that way. I know that's bound to confuse one person or the other. So yeah. Okay, finally, this is like the last big segment of our lesson. What's in the money or out of the money? OTM versus ITM is the acronym for it. So, in order to figure out whether an option is out of the money or in the money, a lot of computer programs, at least Thinkorswim, do show it. Like here, they'll use the shaded ones are in the money, other black ones are out of the money. Think about it. Are you saving or getting more? So, a call is the right to buy, right? So, a call, we would consider a call in the money when the strike price, or the price that it is currently at, the price that you have to pay once, the predetermined price after you pay the premium and everything and get the option, that predetermined price, when it's less than the current price of the stock. So like for example, we had a great option example. Let's buy single. Yeah, here. So 270, 277.97. We would consider this in the money because its strike price is lower than the current price. So we're getting it for a discount, right? Who doesn't want to buy something for less and save more money? So it's in the money there. Puts, on the other hand, are considered in the money when the strike price is greater than the current price. Because obviously you want to sell something for the most you can, right? So when the predetermined price for how much you can sell something in a put is greater than the current price of that asset, or like of Apple, Facebook, or the underlying asset as it's called, then we would say it's in the money because you're selling it for more than you would by using the traditional way. This is truly the essence of why someone would choose to buy an option instead of going the regular way and buying something. So yeah, that's it, what it means. Now, this option right here, this is out of the money because it's a put, right? Meaning you have the right to sell. But 270 is less than 277.97. And wouldn't you always want to sell something for the most amount of money? So therefore, it's more logical that I would just rather hit sell the regular way instead of going through the hassle of using an option to sell it. But just because a contract is currently out of the money does not necessarily mean you should disregard it and only look at the shaded ones in the money. Sometimes the best deals can spur from OTM, from options that were in OTM for a while. Options are important because options tradings are now more prevalent than ever. They're a huge way and a new way for you to make money. Hedge funds also would use them to hedge risk. You can use them in your own trading strategies, and they're just in general just another way for you to make money in stocks. So I mean stocks, but so yeah, thank you guys. My name is Anish Lakapragada. Remember to comment, subscribe, like, share, subscribe. If you have any questions, don't hesitate to put them in the comment section below. Any feedback, anything you like to see in newer videos, just drop a like button. Do what to do. Anyways, see you guys later.